Hare Krishna. Welcome to my channel Purposeful Prosperity. We are continuing with our wisdom series from the Little Book of Common Sense Investing, and today we are trying to explore the chapter 19, which is continuing from the previous chapter of this is the part 2 of asset allocation. This will be mainly focusing on retirement investing and the funds that sets your asset allocation in advance. So in this chapter, Bogle is first of all beginning with the balance or the hybrid mutual funds. Uh, so balance funds are something which is having some portion of equity and some portion of stocks. So if they have more portion of equity, then they are called equity oriented balance fund. And if they have more portion of debt, then they are called the balance debt oriented funds. So let's just understand more about what are these balanced mutual funds. So as per Bogle, the Bogle is taking always a ratio of what 60-40, where he says 60% is in stock and 40% in bonds, is the one which provide extraordinary diversification and operates at a rock bottom cost, would offer the functional equivalent of having an entire portfolio overseen by an investment advisory firm. So that's really important. So he's saying that if you have a balanced fund of having 60% stocks and 60% bonds, and you buy them at a rock bottom cost with a minimum thing, having the sufficient diversification, then this portfolio is going to perform better than any kind of a portfolio of those investment advisory firms. Now, question comes is that why should I go for a balanced mutual fund? So the answer lies in the volatility. So definitely the balanced mutual fund is going to have a lower volatility because we can see the balance index fund is having 8.9% volatility while the S&P 500 is having 14.3. So definitely the risk adjusted return would be even higher. So although the balance fund is having less of the equity portion, but then also the risk adjusted return will be higher. And definitely all those who are looking for a less volatile thing, then I think balance funds are the way to go. Uh, the example being given is that when they are whenever markets are in trouble, the balanced mutual fund offers the exceptional protection. So two of the references which he is giving, first of all in 2000 2002, where the S&P 500 declined by 38%, but the balance fund fall by just 14%. So you look at the difference. So if you are the equity investor and you cannot bear a 38% loss, then definitely that index fund is not for you. You should be exploring the balance funds. Similarly, in 2008, when the S&P 500 was again dipped to 37%, but the balance fund was off again 22%. So we can really see that the volatility or the drawdown is much restricted in case of balance fund compared to a purely equity fund. Uh, Now, Bogle is trying to compare these equity indexes with the balance indexes. And when Bogle talks about these balance fund, he is always talking about the balance index fund, not the balance active funds. Uh, so Bogle is saying that for investors who are having very long time horizon and they have a considerable grit and guts, an investor who has courage to be unintimidated by the periodic market crash, then clearly you should be going with the 100% in S&P 500. That's the way to go because that fund is going to give you an higher return compared to a balanced fund. But for all those, not every investor will have all these qualities. Definitely, that's something we have to understand. So he's saying that if you have a limited time and if you are cowed by the stock market volatility, tempted to liquidate your stock portion when seas are rough, then definitely the pure equity fund is not for you, and you should be going about this 60% stock bond portfolio or the balanced index fund. So balance index fund is the right choice for those kind of a person who are not having those gist and gust of the equity investor. So that's something very important. So once you do your uh, uh, risk evaluation, then I think that's the best thing for you to know whether you have index fund is more suitable to you or a balance index fund is better for you. So let's just see what Benjamin Graham is saying. We are continuing with this learning in the previous chapter, previous chapter. Uh, so Graham says that I see no reason for the retired investor to depart far from the advice of Benjamin Graham offer to all investor. And what is that advice? That advice is that we should be going with the 50-50. I hope you remember in the last uh, session we discussed that Benjamin Graham recommend this 50 to 50, and at the same time it's making it a little bit flexible by saying that you can go from 75 to 25, from 25 to 75, depending on the market conditions also. But in general, a 50-50 portfolio should be good enough for all the retail investors. Now, the higher equity portion of most risk tolerant investors, perhaps seeking greater wealth for themselves and their heirs. Similarly, the lower ratio of risk averse investor willing to sacrifice the potential for greater return in return of some extra peace of mind. So definitely, if you are a risk seeker, then definitely you should be going with the 75-25. And if you are a risk averse investor, then 25-75 is the perfect ratio for you. So again, that risk evaluation is something that we should be doing, and based on that, you'll be able to select the what kind of percentage that you are going to go. But in general, Benjamin Graham formula, if you like to take, then 50-50 is the perfect ratio. Now, there is another famous term which has been quite mentioned in multiple investment videos, which is about the asset allocation by age. They also have this rule of 100 minus your age. So that should be your asset allocation, especially in the equity. So we say that if you are having an age of 30, then definitely your 70, 100 minus 30 is 70. So 70% can go into equity and 30% remain in a debt. And similarly, if you become an age of 75, then again 25% should be in a debt. 25% should be in equity and 75% should be in a debt. So this 100 minus your age rule, we can also say that whatever is your age, the equal amount should be your bond position. So both the rules are going telling the same thing. So this is something. So as per Bogle, so this asset allocation strategy can serve the needs of many, but not most investor quite well. So definitely it cannot be applied for all actually. So Bogle says that I have never intended to be more than a rule of thumb, a place to begin your thought process. So definitely Bogle is clearly saying that it should not be more than a thumb rule. So definitely you cannot always restrict yourself that okay, I am my age is 40, so I cannot have more than 60%. No, it's completely depending on what kind of scenario, what kind of time horizon you are looking, what kind of assets you have calculated, what is your uh, risk portfolio, risk assessment. All those things are going to decide. So definitely this cannot be taken as a generalized thing. But yes, it can be a starting point for you to think. Then Bogle further says that I hardly intended such an age-based rule of thumb to be rigidly applied. So we have to understand that we should not be applied this kind of a rule rigidly. If we are doing it, then we are making a mistake. So we should be always flexible. That's something really important. So flexibility is the key in investment also. So we don't only want to make our investment simple, but they should be flexible. Next, Bogle continues about the checks in the mail quote, where he says that as we age, we begin to rely less on the human capital and more on our investment capital. So definitely, as we age, we might get required, and we might be in a position where we might not be able to work or earn. Then definitely, we have to rely more on the investment capital. So this frequently peaking of the value of our investment is not only unproductive but counterproductive. So definitely, if you are taking money more frequently from your investment capital, so that's also not something really good. So, what we really seek is a retirement income that is steady and, if possible, grows with inflation. That's really important. We don't want our whatever corpus that we have collected at the time of retirement, it should be falling behind the inflation. Then that means our investment capital is getting reduced day by day. So even after post retirement, we should be getting inflation beating return. That's really important if we want to have our retirement without any financial issues. And Bogle says the social security fits this criteria perfectly, and with moderate risk, a balanced mutual fund portfolio can effectively supplement social security payments. So here Bogle is introducing another term called social security. I would say this is good for countries like US, developed countries. But then if you look at India, we don't have any social security kind of thing. But definitely if you look for government employees, then definitely they are going to get some pensions. And nowadays, even those government pensions have been also moved into a NPS kind of a thing, where a particular portion you have to put as an annuity, and that annuity is going to give you some monthly payouts. So definitely this social security, and plus if you have this balanced mutual fund portfolio, then that's going to supplement together. So for retirement thing, I think he is clearly mentioning that we should not be going completely with the equity fund. And he instead Bogle is recommending a balanced mutual fund. That's something, a balanced index fund. That's something we should be looking for our portfolio, especially with the retirement planning. So now comes another important term. So nowadays we see that earlier all this asset allocation talks about only two components. One is your stocks and one is your bonds. But now recently there has been a lot of change, and now there is a three fund model portfolio where people are also adding some international exposure. So they are also adding some international index funds, and different mutual fund houses are putting up different ratios. But then Bogle is pretty clear, and he says that I advise investors that they do not need to hold international stocks in their portfolio, and in any event should not allocate more than 20% of their stock portfolio to any international fund, however good it may be. So that can be a rule that we should be noting down, that if you really, ideally you should not be investing in international fund, and if you really need this, then make sure that you don't allocate more than 20%. That's an advice Bogle is giving to all retail investors. And apart from this, Bogle is also adding a couple of questions, and he said that all these questions has to be answered. Now we have seen that in the previous slide, Bogle says that you should be restricting to 20%, but now he is going to give us a couple of questions that can guide us, or that can help us decide whether to go for an international exposure or not. So you can be in any country, it doesn't matter. But then these questions are pretty generic. And if you have an answer for these questions, and if most of these questions are yes, then only you should be going for the international exposure. So first of all, he's beginning with that we earn our money in local currency, spend it in local, save it in local, invest in local, then why to take currency risk? So you should be asking is that why to take currency risk? So if you have some valid arguments, then definitely you have one point to be added for your international exposure. Second thing is asking that haven't our international national institution been generally stronger than those of other nation? So that should be a second question you are asking, that are all the cooperation that we have in our nation, are they not strong enough to compete with other nation? If you feel the answer is no, then definitely you need some exposure in the international market also. Then third thing is asking is that don't half of the revenue and profit of the corporation already comes from outside our nation? So if you look at the US stock companies, so I think there most of these questions are pretty clear. So especially for a US investor, it doesn't make sense for him to go for international funds. But if you are in a countries like India, then definitely there are some points which are yes and some points which are no, because especially in India, we haven't yet reached to a position where our corporations are earning these revenue and profits more than half or at least half from outside the nation. We are still highly depending on our internal consumption. So then we can be have some exposure on the international front. But once again, we have to see that simplicity is the key, and all these things are going to add more and more complexities. So if you really want to avoid complexity, then simply listen to the Bogle and say that, okay, I'm going to avoid the international fund. And then fourth point, he's asking that isn't our national GDP likely to grow at least as fast as the GDP of the rest of the developed world, perhaps, or at even higher rate? So we really understand that, especially if you take an example of India, then our GDP is growing highest among all the nations. then definitely this question clearly says that we should not be investing international funds because our GDP is performing the highest. If we are the one going to grow faster, then why not invest in our own nation? Then last point, he is saying that all these things, all the 4 points, he's saying that we all have is consider the probability, and you need to make your own judgment. So we need to use our common sense to decide whether to take an internal exposure or not. But definitely, these 4 questions can be a foundation stone for you to help decide, do you need an internal exposure? And if you really need it, then make sure it falls below 20% limit and not crossing more than that. Then Bogle further continues and says that I soon came to the obvious conclusion that this arbitrary 40-60 balance ratio, perhaps the most sensible ratio for investors seeking in balance risk and return, might not be suitable for all investors. So definitely we have to understand that in any kind of funds, you cannot, for all investors, there cannot be a fixed ratio. So that's something really important. So although he is saying that if this 40-60 is going to work with most investor, but then it cannot be for all. So definitely the element of flexibility is always there in determining what kind of ratio we need for our balance portfolio. Now Bogle is introducing another term about the target date funds. What are these target date funds? So target date funds hold diversified portfolio of stocks and bonds, and they gradually become more conservative as the fund approaches its target date. Usually, the year where the investor expected to retire or where when your goal is going to get completed. So their concept essentially replacing stocks and bonds as a needs to fund future liabilities draws closer can be applied to other investment goal also. So these target date funds are becoming more popular for retirements, but then they can be applied to any funds. The aim is that you are beginning with a higher equity portion, but then as and when you are moving towards your redemption date, your debt portion is going to increase accordingly. So I think if you relate this with India, then I would say I think you should be looking how an NPS is going to do. So after the age of 50, NPS is automatically reducing your portion into equity and adding more of that portion into the debt. So your NPS is also following some sort of a target date methodology. So one of the reason of the popularity of target date fund is their simplicity. So definitely everything is being simplified here, because if you invest completely in the equity, then it is your responsibility to become that as and when we move closer to the date, you make sure that uh, you transfer those equity funds to the safer assets, because the dates is becoming closer and you don't know, maybe 2 months just before your redemption, your market can suddenly have a collapse, and then all your goals are going to have that suffering. So that's leaving up to you. But then target dates funds are really simplifying those things. That's why people are preferring these kind of funds. So for this target dates fund, Bogle says that all you need to do is estimate what year you plan to retire or your children will start your college, and then invest in the fund which is closest to that target date. Set it and then forget it. That's the idea. So they can be excellent choice only for investor who are just getting started with their investment program, and also for the investor who decided to adopt a simple strategy for funding their retirement. So these target date funds are really good for your retirement purpose. So definitely we can get some hint that the NPS that we have, especially in India, that's going to work as a target date fund, and it's going to be really beneficial for all of us. But as at the end, Bogle is also adding is that, but as your asset accumulated and your personal balance sheets and the investment goals become more complicated, it is worth considering the use of individual building blocks like low cost stocks and bond index fund to construct your portfolio. So from this we can take is that once our investment corpus become really large and we have too many of investment goals, then this target date fund doesn't make sense. Then in that case, it's better that we have a balance funds where we have this low cost stocks and the bond index fund. That's the way to go. And at the end, Bogle is giving us a warning where he says that if you choose to invest in this target date funds, I encourage you to look under the hood first. So definitely, we have to compare the cost of these target date funds and pay attention to their underlying structure, because some of these target date funds might be adding active mutual funds for the bonds and the stocks. So that's something we should be avoiding. And Bogle says that I believe that the low cost index based target date fund are likely to be your best option. So definitely, if you are selecting a target date fund, although in India I don't see much of the funds available, there are target date funds available, but that's mostly for the debt funds, not the equity and debt combination. So definitely they will be also launching soon, because whatever US does, I think most of the developing markets are going to follow all those things. So here also they're going to be launched, but I think we will be well prepared with this knowledge is that we should be selecting a target date fund who is using index-based approach, low cost index-based approach for both bond and stocks. Now, Bogle is introducing another term called social security and its use in asset allocation. So Bogle says that when determining the asset allocation, most investors need to take social security into consideration as a bond-like asset. So that's something really important. So this target date fund generally ignores the social security income, and that leads to investor holding more conservative portfolio than they might realize. Why? Because there is some monthly income you are going to get from your social security. You can compare this with an EPA, EPF of or NPS in India. So you are going to have a debt portion already there. So if you ignore that thing and if you follow some equity debt portfolio, a separate ratio, ignoring those things, then definitely you are becoming more and more conservative, because most of your portion is in debt now. So he's saying that we should not be considering and adding those secure social security things while making our asset allocation. So he clearly says that while these target date funds may ignore social security as a bond like asset, but you should not be allocating. Otherwise, we'll be putting too much of our assets into bonds compared to the equity. That's where they have the chance to grow. Now, Bogle is answering one more question where people say that, okay, should I defer the social security payments? I think many people in India also they take multiple pension plans, and in those pension plans there is an option to defer these pensions. So Bogle is clear, and we always confuse that should I take the pension now itself, or do I want to defer my payments or my pension payments? Uh, so Bogle says that the deferring social payment substantially enhances the monthly payment you later receive, but at the expense of not receiving any social security payment at all during the interim term. So let's say if my pension is going to start after 5 years from now onwards, and let's say I want to defer it by another 10 years, and I will start my taking pension after 15 years. So definitely in those 10 years, whatever pension that I have supposed to get, although it might be lower, but then I have to make some sort of a balance. So I know that for 10 years I have lost some pension, but then for the remaining years I am going to get some higher pension. So definitely you need to make some balance. So you have to must balance the opportunity to increase those eventual monthly payout against the absence of those monthly payout over a full decade. So based on that, I think you'll be able to best judge whether to defer your pensions or not. Now, Bogle is introducing another terms which are called retirement accounts. So, these retirement accounts are having tax advantage retirement saving vehicles that make achieving the retirement goal much easier. And we need to really decide which one is right for us. So, there can be many retirement accounts for us, but as a retail investor, we should be thinking which is going to match with my behavior or with my investment knowledge. So, the first of all, so here Bogle is giving, since this book is mostly based on US, but I think we'll be able to correlate this thing for any of these countries. So the first thing he is beginning is with the defined contribution DC plans. So these plans allow you, the employee or the investor, to defer income directly out of your pay into your retirement account. So like you have the option to, let's say, 10,000, the company can give it to you, but you decide that no, I don't want this 10,000. You put it into my retirement account and let it grow. So most common DC plan is this 401k for the US, which allow you to save money for retirement on a pre-tax basis, and your contributions are often matched by the employee according to a predefined formula. So if you take a comparison with India, then I will say I think EPF is going to fall in this kind of a category because you are because whatever EPF that you are going to pay, 12% of that is going to match by your employer. Now, as your investment returns on your asset grow on a tax deferred basis until you withdraw them on retirement. So definitely we are not going to pay taxes. But in case of this defined contribution plan, you have to pay the taxes once you withdraw them. But if you take an example of our EPF, we have completely as exemption even at the time of withdrawal also. But definitely there can be some plans where if you withdraw later on, you need to pay some taxes. Uh, uh, So, and then these there are provisions for loan on your accounts and your LD withdrawal in case you experiences financial hardship during your working years. So our EPF, our NPS, some portion of NPS, or I would say, PF can also be, I would say, categorized into these things. But I would say, I think EPF is the one which is quite in sync with this defined contribution plans. Now we have something called traditional IRAs. So the tax advantage of the traditional IRAs are similar to that of the EC plan. Your contributions are usually tax deductible and they grow in a tax deferred until you withdraw them. But only thing is that here there is a limit on the maximum annual contribution that you can make. So those are the traditional investment plan. But if you look at the previous one, there is no higher limit on that thing. So whatever in the DC plans, your employer is going to match with whatever contribution you are making. But here the contribution limit has been restricted with the traditional IRA plan. And the last one comes is the Roth IRA. So there is no tax deduction at your contribution. They are fully taxed, but withdrawal up to onto retirements are entirely tax free, including your accumulated gain on your assets. So this Roth IRA is likely to be a better choice for most new investors. So if you are the new investor, then definitely try to put your retirement assets into a vehicle which is similar kind of a Roth IRA, where maybe in the beginning you are paying some tax, but then when you are trying to withdraw them on retirement, you are completely tax free because your all those assets are going to grow in a vehicle which is completely tax free. So here are a couple of examples which I'm able to find, which are the retirement plans in India. So we have this triple E category, which is exempt, 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 and the things that fall under this category is EPF, your PPF, your Sukanya Samriddhi, your life insurance policies. Then we have EET, so exempt, exempt, and then tax. So you have your pension policies, your ELSs, your national pension schemes, because but nowadays even there are some amendments which allow your NPS also to go into triple E category. So all those things are been evolving, and then you have some ETE. So we have this tax saving FDs, NSC, the senior saving citizens saving schemes. So all these options are there for retirement planning. So these are our retirement accounts. We can take them, and we need to be really wisely selecting which one is going to suit me, and accordingly we should be selecting the right investment plan, right investment vehicle for our retirement. Now, Bogle is introducing another term, which is this 4% withdrawal rule, which is pretty famous, where he says that the thumb rule suggests that an annual withdrawal rate of 4% of the year end value of your initial retirement capital, adjusted annually for inflation, is likely to be sustainable throughout your retirement years. So, definitely, and further it says that it can, if you have a retirement year for close to 30 years, and if you follow this principle of 4 but not withdrawing more than 4% of your investment portfolio each year, then definitely that money is going to help you sustain up to an age of 30. up to your 30 years of retirement. So do not adhere rigorously. Bogle is clearly warning us and says that do not adhere rigorously to spending rules such as 4% annually. So once again, the flexibility should be there in our rules. You cannot be rigid. So you maintain a level of flexibility in your retirement spending plans. If the markets are particularly bad, then tighten your belts and draw down a little less. And similarly, if the markets are good and your spending rates provide higher payment than you need, then reinvest that extra amount. Uh, uh, Once again, to make it grow. So that's something we should be doing. So don't just rigidly follow this 4% rule. Have the flexibility, and depending on the market condition, you can increase or decrease. Now, at the end of this chapter, Bogle is saying this important thing that there are no guarantees. We have uncertainties in our investment journey. So Bogle is saying that, let me reiterate, any asset allocation strategy is subject to numerous risks: stock market risk, payout risk, microeconomics risks, and other risks in the fragile world in which we exist. So nothing is guaranteed. All we can do is make informed judgment and then be flexible in our allocation and pay out as condition changes. So the flexibility, the simplicity has to be there. There is no asset allocation which is completely free from all kind of a risk. Nothing is guaranteed in any asset allocation. But yes, if you really take this informed decision and have the flexibility in your allocations, then definitely you are going to do good compared to most of the retail investors. So I would like to further add this quote from Ray Dalio where he says that you should have a strategic asset allocation mix that assume that you don't know what the future is going to hold. So Ray Dalio is also saying that there are no guarantees about the future, and the same thing Bogle has repeated in the previous slide. There is again a very famous book, The Wealth to Common Sense, written by Bell Gunson, where Mr. Carlson concludes that this has nothing to do with active or passive investing. It is all about simple versus complex, operational efficient versus operationally inefficient. Similarly, high probability versus low probability portfolio. So don't say that we are having active or passive war. No, no, no. We are talking about the simplicity and the complexity. So your index funds are simple, they are more operationally efficient, they are having a high probability portfolio. That's why we are recommending the index fund. And Mr. Ben Carlson says that investing is hard enough as it is because introducing a complex, inefficient, low probability investment style. So investment itself is pretty hard already. And if you have these kind of a complexity by adding this active indexing, by investing those active mutual funds or these factor based investing or this tactical asset allocation, then all those things are making it more and more complex, inefficient, and definitely then both of them are going to cause your portfolio to grow with a low probability. And that's why he says the simple, efficient, and high probability Bogle models always wins. That is his conclusion. And we should be listening to this. Always go for a simple, efficient, and high probable portfolio. I find one very famous quote where it says that the simplicity is the greatest virtue, but it required hard work to achieve it, and education to appreciate it. And to make matter worse, complexity sells better. So we can see here that he clearly says that complexity always sells better. If I am a AUM company, I am launching some momentum kind of a fund or a fund which is using different kind of data mining and some complex algorithms, then those kind of funds are going to sell at a much faster rate compared to if I am selling an index fund where I say that okay, I'm simply following the Nifty 50 or Nifty 500. Then those there are not much buyer for this. Why? Because your mind somehow always want the complex thing. If somebody says that this is the simplest thing to do, you will not agree. One really good example that comes to my mind is that let's say if you go to a doctor and doctor simply says that okay, you simply sip some lemon early in the morning and you will be really cured, then you will not visit the doctor again. Because you want some kind of a strong antibiotic or some medicines or some sort of inhalers or something given to you, then only you feel that okay, yeah, this doctor is really intelligent and it's giving me so many medicines and all those things. So that's why, because we really want complex things. But then all these great investors are saying that simplicity is the greatest virtue, and it really take long time and really hard work to achieve this thing. And we need the knowledge also for appreciating this simplicity. So all these sessions that we have been doing, so we are, in general, I would say I think most of the investors have read about John Bogle, and they would have said, okay, investing is good, but then they are really not able to appreciate why index investing is good. That's why we have to read this kind of a books associated with these great personalities, great investors, so that we can really appreciate that why simplicity is really great. So I hope this concludes now this asset allocation part 2 chapter. So I would request all my viewers to please go through this previous chapter, asset allocation part 1 and part 2 combined together. Go through this two, three more times so that you try to make some notes out of these sessions, and then based on those notes, try to make your asset allocation, because we understand that in order to make your wealth, asset allocation is the key for that. And if you are ignoring and not paying enough attention on the asset allocation, we are definitely doing harm to ourselves. And if we really are a wise, intelligent investor, then please pay enough attention for these asset allocation, and that's going to help us succeed in our investment journey. So thank you everyone for staying with me for such a long time, and I hope you get something out of these things. And I am sure that these previous two videos from Joel Bogle, these chapter 18 and 19, are going to help us to make our asset allocation simple, and we really understand about their importance. If you think this kind of a contents are really helping, then feel free to like, share, and subscribe these kind of a channel, these kind of contents to more and more retail investor, so that they become a wise retail investors. I will come up with the last chapter very soon, and with that we are going to do a closing of this book reading. Uh, so till then, thank you once again. Hare Krishna.